Hi, Joanna.
Oh, okay.
Ellie, how you doing?
Yeah, good.
Is David? Oh, we're gonna get some people today, huh?
Hey,
Looks like most of you did pretty well on the test, huh? Not too bad. I didn't see any clunkers, real clunkers. Hi, Morgan. Is Morgan with us? Coming out? Okay. All right, we'll get started in a moment here. Um, one of the people who might join our meeting today is a fellow who came to City College about 2 years ago at the age of 74. He's a little older than me. And he took one class to upgrade his real estate license. And he's been coming to class ever since. He's just a likable guy. Hi, Kate. And George, huh? Can you hear me, George? Okay, hold on. I think I gotta. Can you can you hear me, Kate?
Yes.
I can hear you. Can I hear you, George?
yeah, you can hear me.
Okay,
I
all
can
right.
hear
I'm
you.
just doing. All right, we got through chapter 5, which is kind of the basics, and the test scores were not bad, not bad. It's a long test. A couple people have told me they, couldn't quite get every question answered, which can be a real downer. So we're going to go into chapter 6 now, and maybe just wait another moment. Corey's coming in. Hi, Corey.
Hello.
You want to show your face, Corey? You don't have to, but we like to see you. So let me get going here. Let's get going with chapter 6. I trust you can all see the handout now, right? The slideshow. Okay. Chapter 6. Now we're going to get into, after we've gone through the basics, now we're going to get into very specific things that businesses do in the world of accounting and managing a business. And specifically, chapter 6 is going to take us into the world of accounts receivable in a bit of detail, okay? So in this chapter, we're going to talk about receivables and a new elongated, a little longer income statement and some cash issues, all right? So let's get going here. We know this already, right? The revenue principle requires revenues are recorded when they're earned, when the goods are delivered or the service rendered. And this is a new piece here, persuasive evidence of a customer payment. Accounting assumes we're going to get paid, okay? I am going to get into 3 things. Okay, I see what they're doing here. Okay. Special impacts on sales revenue. Right now, you've heard the word sales, and you've seen the term gross sales or just sales, okay? Now we're going to talk about something called net sales. Net sales. Gross sales, which is what you looked at in the prior 5 chapters, that represents the monies, that represents the bills that we sent out to customers. We sold $1 million worth of merchandise in this month. That's the gross sales. That's what we build. But in the real world, guess what? You're not going to collect all that money. You're not going to keep those sales because people do things that you and I have done probably more than a few times. People use credit cards a lot. People use credit cards. You're going to see that reduces our net sales. We have something called a sales discount. Now, this is not a discount where you pick up your newspaper and see that Firestone has a sale on tires, 20% off. This has a very specific meaning in accounting that needs to be understood. And then customers return things. Have you ever bought something at a store and it didn't work? Or you got a gift and you wanted to exchange it or return it? That is a sales return or an allowance where you get a break on the price. And then finally, and the trickiest part of this chapter will be bad debts expense, okay? So what we're going to be talking about here is we're going to start with a sales number that's gross. And then we are going to reduce it by the amount of credit card fees, sales returns and allowances, and people who took a cash discount. So let's take a look here. Companies accept credit cards for obvious reasons: increased sales. They don't have to worry about giving credit to customers, no bad checks, it's pretty safe, and you get paid right away. But when I go to 7-Eleven and I buy my jug of soda every morning for $3, I pay with a credit card. So that's the gross sale. That's the gross sale to 7-Eleven, $3. But because I used a credit card, the credit card company charges 7-Eleven, let's say 1%. So that's 3 cents. So the gross sales for that transaction for 7-Eleven would be $3 for the bottle of soda minus the credit card fee. Credit card fee, okay? The company must pay a fee for the service it provides. That is a crucial aspect of credit cards. And look on the upper right. Say hello to the first of 3 contra revenue accounts. Is that you, Bill?
That's me.
Okay, there's my buddy Bill I was telling you about. I gave you a brief, nice introduction, Bill, and your job is just to be quiet now for the next. It's good to see you. Bill is one of my best students. Always
Shut
good
up
to
and be
see you.
quiet.
Okay, don't have to. Okay, contra revenue. Credit card fees are a contra revenue. Sales have a credit balance. These contra revenue accounts have a debit balance. Sales discounts. Sales discounts. When companies buy on an open account, they may be offered what's called a sales discount. Again, this is not a trade discount you get when you walk into a store and you see there's a sale going on. This is a very, very particular type of discount offered by sellers to encourage early payment. And here is the classic acronym or definition you need to know like the back of your hand. 210 net 30. What this means is this customer is being offered a 2% discount if they pay within 10 days. That's how you read that. 2% 10 days. Otherwise, they pay the net in 30. So 210 net 30 means 2% discount if you're willing to pay early in 10 days, or you pay the whole thing in 30 days. And this thing could be 3% 45, it could be 2% 60. The key is understand how to read that. And that is also going to be your second contra account. 2%, 10 days. Otherwise, you have to pay the whole boat, okay? What if somebody offered you a 2% discount right now? Do you think it would be a good idea to take it, or it's probably not that much to worry about?
Well,
The
from
answer is
for the
in this. Go ahead. I'm sorry. Is that George?
Oh, yeah. From the reading, it says that yes, it would actually be beneficial to go ahead and take it now, because in the long run, that 2% right now, it would add up to like 37% something in like a whole year, compared to like if you just bought it right away.
Yeah, I hope you all read that in the chapter, what George is saying. If you get a 2% discount in 10 days, that's the equivalent to about 37 a year, because you're not collecting 2% a year. You're collecting 2% every 10 days. And roughly 18 times 2 is 36. Okay? So you would be nuts not to take that discount. I mean, that's a real boon if you did. And here's what George, I think, was going after here. When to take or not to take, with discount terms of 210 net 30, you save $10. So here's our little calculation. You save $2 by giving up your money for 20 days. So we're going to take the $2 that you saved and divide it by the amount that you actually paid. So 2.04% is how much interest you earned in 10 days. If you went to a bank today with $100, it would take you probably over 2 years to get 2%. Okay? And here's what George was saying. The annual, there are 365 days in a year, right? And let me just get this thing out of the way. I'm trying to read this. 365 days in a year. We're collecting this, we're giving up our money for 20 days, which is 18 times a year times 37%. Now, I don't think you need to worry about how to do the calculation, but I'm pretty sure they'll be on a test where they'll give you a situation and ask you to pick the right percentage. And if they give you something like 3%, 10, net 30, well, you know the number's not going to be 3%. It's going to be much higher than that. So the point is, taking a sales discount of 2% in today's world is certainly worthwhile. Now, when I first got out of school, it was during the inflation, runaway inflation era, where interest rates were 22% a year. You could put money in the bank and earn 18%, believe it or not. And then in those days, you might not want to take the interest because the bank was better. This is our third and last contra revenue account. You return something to a customer, to a vendor rather. You bought a toaster from I don't know, Costco, and you brought the toaster back because it didn't do the job you wanted. That is a sales return as far as Costco is concerned, and it reduces their gross sales. So what we're leading up to, everybody, is we're taking those gross sales. That's the amount you actually billed, and we are going to subtract the credit card discounts. We're going to subtract the sales discounts, and you're going to subtract the sales returns and allowances to get what we now call net sales. And I have the guitar here, and I'm willing to use it if you don't understand this. Sales account, you never debit sales. You never debit sales. Can you remember that annoying sound in your head? You never debit sales, right, Bill?
Right.
Right, you know, thank you. Bill's here just to cheerlead me. You never debit sales, but you do have to reduce the gross sales by debiting these three contra revenue accounts. That's how we get from gross sales to net sales, and that's how your income statement is going to look at the beginning now. Any questions on that? Anybody unclear what we mean by a credit card discount or a sales discount return? Okay. Now, that was a quick look at gross to net sales. Now we're going to get into another subject in chapter 6. And here we go. Measuring and reporting receivables. When customers are allowed to purchase merchandise on an open account, the expectation is they pay the company in the future, okay? Accounts receivable. Remember, accounts receivable are what is owed to us at any point in time by customers. Non-trade receivables would be like interest receivable, or my favorite where I used to work, we gave out employee loans once in a while, small amounts. That would be an employee receivable. Trade receivables, accounts receivable. Now, here we go with some of the trickier stuff here. Bad debts. Bad debts expense needs to be recorded not when you find out someone is not going to pay you. You have to anticipate it, and you have to estimate it, and it's done on certain bases. Bad debts result from credit customers who will not pay the business the amount that they owe, regardless of what you do. Excuse me. Excuse me for a second. Ugh. You sold something to me for $1,000, and I'm not a crook, I'm not dishonest, but what happened was my business fell apart. I'm going bankrupt. You have been calling me for payment for 90 days. Bob, when are you going to pay the bill? And I finally have to say, I'm so sorry, guys. I'm declaring bankruptcy today. I have no assets. You're never going to get paid. That is a bad debt expense. And you have to remove me from the accounts receivable aging, which we'll discuss. But you don't do that when I tell you I'm a bum. You have to anticipate it. So businesses estimate the amount of bad debt expense, and this is a new adjusting journal entry. And that journal entry, as you probably figured out here, is going to be to debit bad debt expense, because as we learned, an adjusting journal entry is pretty much a hunt for missing expenses. So let's see what we have here. Recording bad debt expenses. Okay, they're giving us the number. I just wanted to skip ahead briefly. Okay. Here, Deckers, that's the shoe store. They are estimating bad debt expenses for the year to be $4,685,000. And we're going to shortly get into how they came up with that number. But it is an estimate, and that's important to understand. So here is we're going to start by showing the journal entry. That's their estimate. So take a look at your journal entry. And now we're getting into some trickier areas, but hopefully it'll be a little more interesting because these are things businesses do all the time, okay? Deckers estimated for this month, bad debt expense is going to be $4,685,000. This means based on their analysis of their accounts receivables, they do not expect to receive $4,685,000 from customers. They don't know who those people are yet, but they must record the bad debt expense in the month of the sale because that would match the expense properly with the sale, okay? And this, you're going to have to kind of fight your way through this a little bit, doing some of these calculations. And I think you're going to find once the light goes on, it's not that tough here. So let's take a look at a new account. Your adjusting journal entry is a debit to bad debt expense. And guess what? We have a new, our fourth, contra account, allowance for bad debts. That is a contra asset account. We learned that contra accounts are married to a master, if you will. Contra account allowance for bad debts is the spouse of accounts receivable. So accounts receivable, which represents all of the bills you sent out to customers that are unpaid, less this allowance gives you something that's very important to understand, net receivables. That's how much we think we're actually going to collect. The whole point is you can't wait to record bad debt expense. You have to do it in advance. You have to anticipate it. And here is what we're looking at here. This is what it's going to look like on your balance sheet. Before, you just saw one line for accounts receivable, right, guys? Accounts receivable. Now you're going to see less allowance for doubtful accounts. And this is going to be called, they're giving it a fancy name, net realizable value of, it's net receivables is what the world calls that. Net receivables. That's the amount they expect to collect. All right. I'm going to move along here. Your first entry I'm going to go back to our adjusting entry for one reason. In this section of the book, when we're talking about bad debt expense, the allowance, there are only two. Where's my fingers? Two. I can't put my fingers up. There we go. Anyway, I'm trying to put two fingers up. Okay. Two journal entries. Two-line journal entries. That's all you have in this section. You debit bad debt expense just one time only at the end of the month as an adjusting entry. You only touch bad debt expense at the end of the month and never again. The allowance for doubtful accounts, that gets credited just once a month, okay? But when we find out who the bum is, when it's clear that a specific accounts receivable will be uncollectible, now is when we can remove it from accounts receivable using our doubtful accounts, our allowance for doubtful accounts. We set up that allowance for doubtful accounts to offset future AR losses. Decker actually wrote off almost $6 million worth of customers. Oh, wow. 6 million customers told them we're not going to pay. Let's look at our journal entry. Look at that journal entry. When we know who the person is that's not going to pay us, now we can reduce the asset, accounts receivable, with a credit and reduce this contra asset with a debit. The allowance for doubtful accounts is just like an allowance your mother gave you, but you're only allowed to use it for, say, school supplies, okay? Maybe think of it that way. The allowance for doubtful accounts represents an amount we're putting aside when we need to reduce accounts receivable. And please note that both of these accounts are asset accounts, so there's really no impact at all on the financial statements except a reclass of two accounts receivable accounts, two AR accounts. Okay, did I lose you all already?
Can I ask a question?
Sure, go ahead, Kate.
Why do you debit that account?
The allowance for doubtful accounts? Because it has a normal credit balance and you set it up with a debit to bad debt expense and a credit to the liability, to the allowance. Okay? When you estimate your bad debt expense, you're crediting this. This is the normal balance of this contra asset. Now, when you know who is not going to pay you, now is the time we're going to use that money. And here they're giving you an example using a different number.
So what happens to that difference? Like, how do you record that, or how is that reflected?
The difference,
in the
that's going to be your
journal
net
entry?
receivables.
Okay.
What's going to happen here is, let's say you used to have, say, $16,969,000 on your aging. That's how much you billed out to customers. Now you find out that one particular customer, a big one, is not going to pay you. You have to take it off accounts receivable. It's no longer a good receivable. And we've already put the expense up in the prior month by our estimate. So this is just an exchange of assets, if you will.
So by an allowance, it means that you've actually set money aside and put
Yes.
it into a specific account.
Right.
That's why originally it was a.
Yep.
But you treat that kind of like a credit, right?
That is exactly what it is. It has a credit balance, yeah.
Okay.
Assets have a debit balance. This account has a credit balance, and it will only be reduced when we find out for sure who is not going to pay us, okay?
Okay, got it. Thank you.
See, I just want to see. Oh, hi, David, Joanna. I'm just picking up on who's here. Hi, Brad. Brad's here, okay. Write off, okay. let's just, now here's what I was just, maybe this will make it a little bit clear. Here's what I was just talking about. Remember I said it doesn't really affect anything? Here's what I mean by that. Assume before the write-off, Deckers had 62,640,000 in accounts receivable, and they had an allowance of $13 million. That's a big company, huh? Now they found out that David here, you're not going to pay your $6 million, huh, David? $6,969,000. Nice going, pal. We have to remove David from our records. We know we're not going to get paid. So before we found out David wasn't going to pay us, we had 62 million. Now we know he's not going to pay us the 60, what is it, 6,000,009 or whatever that was. So our AR goes down, and so does our allowance account. This goes down with a credit. This goes down with a debit. The overall impact is zero. The only thing that has visibly changed is when we look at our accounts receivable aging now, it's not going to show 55 million. I'm sorry, 62 million. It's going to show $55 million worth of customers, and we have a remaining allowance of 6 million to cover them. And that's a little tricky. You know, you got to think about it a little bit. When we're writing something off, all we're doing is exchanging two assets. A contra asset called the allowance, mastered by the accounts receivable. Now, here we go. This is an interesting chapter once you get going here. Now, here we go. Estimating bad debts. There are two methods. The percentage of sales method, which is the simpler method, which is an inferior method, which is not a method I don't believe any company worth its salt would use. They would use the other method. Let me just take a bite of my whiskey here. It's good booze. Percentage of credit sales. We are going to look at the credit sales for the month. And notice that I said credit sales. We don't have to worry about cash sales because we've already collected the money. So be careful when you're doing your homework that you're working with the credit sales, because a lot of the problems will say total sales were $1 million, cash sales were 200,000. 800 would be credit sales. So this method's pretty easy. We are going to take the credit sales for the month of, say, July in a couple weeks, and we're going to multiply that by a percentage. And that percentage is whatever the company feels is rational and systematic and rational and represents the future. In other words, this company may be in business for quite a while, and their experience is they lose $2 out of every 100 they bill. So as soon as they sell something for $100, they know they're probably not going to collect $2. So let's see what they're doing in this example here. Credit sales of 600,000. So they're using 1%. 1%. 600,000, move the decimal over 2 points, huh? There's the journal entry for this particular month. You debit bad debt expense and you credit the allowance. When you take the credit sales times the percentage, you get the bad debt expense for the month. That's pretty easy. What do you think, Callie? That's not too tough right now? Uh-oh, Callie's not. Take $600,000 times 1%, and that gives you your bad debt expense. And there's your journal entry, which you're only going to do at month end one time. Now, here is the proper method, the better method, and we'll talk a little bit about that. We're going to do it based not on the sales, but on the accounts receivable. And this one is a little trickier to compute, but I think the first thing we need to understand is what we're computing. When we took the sales and multiplied it by 1%. That gave to us the bad debt expense. When we do our calculation based on the aging, we are not going to get the bad debt expense. We're going to get the desired ending balance in the allowance. Let me repeat that. Under the sales method, you're computing the bad debt expense. Under this method, you are saying to yourself, aha, using this method, I came up with a number, but that number is not the bad debt expense. It's the amount we want in that allowance account at the end of the month. Now, you're going to be working a little bit in this chapter with what's called an aging. An aging of accounts receivable is simply a report that lists all of your customers and the total amount they owe, and then it's followed by various a row of columns in 30-day increments. So Corey owes our company $1 million. 200,000 is in the 0 to 30-day column. That amount is only 30 days old. 31 to 60 is older, etc. The older it gets, the less likely you are going to be paid. And here's a real simple look at a portion of an aging. And let's understand this. This company here, whoever it is, has a whole pile of customers, but they're just showing you 4 out of there, okay? Based on past experience, the business estimates the percentage of uncollectible accounts in each column, in each time category. We're going to multiply these out by the percentage and then add them across, huh? So let's take a look here. You have all these customers. Aaron owes us $235. Well, that's not very old, okay? It's slightly old. And our experience is if it lapses into the 1 to 30-day column, we're going to lose 4%. By the way, that's a big number. I've never seen a number that big in 30 days. But as soon as we bill something out, even if it's not yet due, we're going to not write off, let me correct that. That's a terrible word to use, not write off. But we're going to estimate 1%, 30 days, 3%, as it gets older and older. And then if it's over 90 days, where I used to work, if it was over 90 days and less than $500, my orders were to write it off, get rid of it. Did that mean we stopped trying to collect it? No, not necessarily. What we might do is have somebody dedicate themselves to pestering these people we wrote off, or more likely you turn it over to a collection agency and hopefully they can salvage something for you, okay? So we multiply the columns, we get our answer, add across horizontally. That is not the bad debt expense. That is going to be our ending balance in the contra receivables account called allowance for bad debts, okay? Allowance for doubtful accounts. So let's look at our account. At the end of the month, before we adjust, there's a balance of $50 there. $50 credit balance, that's the normal balance. How much do we desire? 1201. This is how much has to be in the ending balance of that account. So here is the amount of bad debt expense. And I know it's a little confusing when we're first looking at it. And we'll go over this in great detail, and we can hook up on Zoom later in the week, whatever, to get through these 3 chapters here. Now, let's look at this T account. You had a beginning balance of 50. We wanted to end up at 1201, so we had to write a journal entry where we debited bad debt expense and we credited this allowance, okay? That's the journal entry. The key takeaway here is the accounts receivable method is a little trickier because it's a 2-step process. You have to come up with the ending balance you want and then adjust to it. I'm going to give you another clue here. Allowance for doubtful accounts. The only time you credit this is when you debit bad debt expense. Let me repeat that because I think that's very important and useful. Whenever you see a credit to allowance for doubtful accounts, you know the debit was the bad debt expense because the credit increases the allowance by recognizing the bad debt expense. Credit in the allowance account means a debit to bad debt expense. No exceptions to that. If you see a debit to the allowance account, you're reducing it with a debit, and the credit automatically goes to accounts receivable. So when you're reducing the allowance for doubtful accounts, remember what the allowance is for. It reduces accounts receivable. And maybe if you're doing your homework, you might focus on it. Maybe draw the T account on a piece of paper, and left side would be a credit to AR, and the right side here would be debit to bad debt expense. For aging of accounts receivable, you take your receivables, you do your calculation. That gives you the ending we want minus what's already there. So that's why this one's a little trickier. Definitely a little trickier, okay? So that takes us now through what I think you're going to find is the trickiest part of this chapter. It's going to take a little bit of doing the problems a little bit and get a sense of what we're trying to accomplish. We're trying to estimate expenses in advance and then reduce the AR when we find out who's no good, okay? Now, let's talk about some journal entries regarding the contra revenue accounts, okay? Credit card discounts. Decker's Factory Stores credit card sales were $3,000, and they have to pay Visa 3%. So their journal entry is going to reduce gross sales. And you never debit sales, you never debit sales, you never debit sales. You get the idea? Hint, hint, you never. But you have to reduce gross sales by, looks like $90. So let's take a look at this journal entry, huh? And let's see what we have here. We sold something for $3,000. Someone came into our shoe store, and I went in there and I bought one of my $3,000 pair of shoes I wear, right? I went in there and I used a credit card. So Deckers says to themselves, well, that's a legitimate sale, $3,000. That's our revenue. That's our gross sale. But this guy used a credit card. The minute they swiped your credit card into their system, it, in essence, created this journal entry. Credit sales for $3,000. Debit credit card discounts, which is not an expense. It is a contra revenue account. Accounts receivable 2,910. That's how much they're actually going to receive. And by the way, in this class here, see where it says accounts receivable? As far as I'm concerned, that should say cash. Technically, it's receivable. But as soon as they swipe your credit card, they're getting that $2,910 in cash in a matter of moments, okay? Credit card discounts. Credit cards are cash, just like coins and bills and wire transfers and checks and direct deposits and letters of credit. You don't hear that anymore, letters of credit. Now, let's go to the second of our three contra revenue accounts. Deckers sold a $1,000 pair of boots. The terms are 2%, 10, net 30. 2%, 10, net 30. So how do we record the sale? How do we record the sale? Oh, look at that. they ignored the 2% discount. You ignore it at the point of the sale. So when they sold this stuff, 2%, 10, it could have been 5%, 100, 20%, whatever. At this point, you don't know if the customer is going to take the discount, right? So at this point, you simply record the sale. Debit to accounts receivable, credit to sales revenue. Don't worry about any discount yet. No one's taken a discount. Now, the terms were 210 net 30, okay? And I need to do some, give me a second here to move something here. Okay, on January 6th, they sold it, right? They're paying us on the 14th. Did they pay us within 10 days? Yes, they did. Yes, they did. So we sold them, what was it, $1,000. Now, 8 days later, they're paying the bill. So look at the journal entry when you get paid. Now you record the sales discount. Now you debit the contra account called sales discounts for $20. So our net sales are really 980, if you want to call it that. Our sales, our gross sales was 1,000. And naturally, they're going to write us a check for $980. Okay? 980. What if the guy paid you late? The deal is he has to pay us by the 14th or the 16th, rather. We sold it on January 6th. What happens when the guy pays us on the 20th?
For the full amount.
Yep, he's legally, absolutely right, Joe. He's legally amount to pay the full amount. Now let's go into the real world here for a second. Do you ever think a customer pays you late and still takes the discount even though they're not supposed to? You better believe it happens, okay? The question really becomes, as you guys are not necessarily going into the world of accounting to be CPAs, but you're going to be managers, you're going to be entrepreneurs, you're going to be business people, marketing. What do we do with a customer who takes a discount undeservedly? Well, what you can do is bill him on the next invoice, huh? Next time he buys $1,000, you say, hey, pal, you owe us $1,020 because you didn't take the discount. Do you think companies do that automatically? I'll answer my own question. Not where I've worked, because you have to consider who the customer is. Suppose this is a guy who buys hundreds and hundreds of thousands of dollars of stuff from you every month. He faithfully pays you within 10 days, taking the discount, and then he makes this little mistake. I have a feeling you would just ignore it. You don't want to go to a customer like that and say, what's the matter with you? You didn't pay me this $20. The guy says, fine, I'll take my $1 million elsewhere. Our third of the three contra revenue accounts. Somebody returned boots. They returned boots we sold for $500. The boots originally cost us $300. In other words, let's say we made them. We made a pair of boots for $300. We sold it for $500, so we had a profit, huh? But the customer returned the boots. He returned the boots. So that $500 sale disappears, right? So let's see what we're going to do here. The boots cost $300, so we're going to have to put that $300 back in our inventory. And so what we have here is a 4-line journal entry, or two-line journal entries, how you like to do
Okay,
it.
thank you though. I'm listening to this, so.
Okay. So customer returned $500 sale. Our accounts receivable has to be reduced. And because we never debit sales, never debit sales, you debit the contra to sales. So now our accounts receivable, at least for this transaction, is where it should be, which is 0. But he did give us back our asset. He gave us back the shoes. So now we have to debit the inventory, the merchandise inventory, and we have to reduce the cost of goods sold because this is what we debited and credited when we made the sale. We're just reversing that portion of it. I'll let you drink that in for a moment, huh? Sales, returns, and allowances. Okay, you ready for another subject of this chapter? This is a fun chapter, huh? Cash. Cash. Woody Allen, the comedian, said the class that he should have taken in college should have been called Money and Why It Is Good. Cash. Money orders, bank drafts, checks, certificates of deposit, huh? All kinds of automatics here, okay? Cash. Credit cards are cash. Remember where you heard that. Credit cards are cash. Now we're going off on a little bit of a tangent here. I'm not sure I like the way they set this up, but we'll talk about it. Internal controls. Internal controls. Internal control of cash. Companies should have what are called internal controls, policies and procedures that are designed to make sure that they have the assets there, that they're safe, and in so doing, the financial statements will be accurate, huh? Internal controls. And no surprise, cash is the most popular asset to steal. I bet we didn't have to have me tell you that, huh? So cash is the one that requires a lot of protection. Cash, something as simple as you have a petty cash box with $100 on your desk all day. At the end of the day, you lock the box and you put it in a safe or a locked drawer. Simple as something as simple as that. Another one is separating duties. You don't want to have the same person doing everything with cash. And forgive me if I repeat myself. I think I did tell you this, but I want to do it again because I think it's important. That poor woman from Santa Barbara High School who is now in jail for a number of years because she worked her way up in the police department to a position of trust. And they said, why don't you record all the money we get? Why don't you keep custody of the money? Why don't you run the computer system and do everything? And so this is the lady who took parking tickets that you and I got on Shoreline Drive, those annoying $40 parking tickets that aggravate us. We mailed the money to the Santa Barbara Police Department, and this woman took that cash with her ability to go into the system. She removed my traffic ticket like it never happened and kept my money. That was an example of somebody being given too much responsibility. Internal control of cash. Now we're getting to the accounting report that is mucho important. The bank reconciliation. And for those of you who took 110, you should have a pretty good memory of this. We're going to go back into bank.
Yeah, definitely.
Okay, good to hear. Do you remember these, Bill?
Yes, sir.
You better. You took 240 for God's sake. Okay, bank reconciliations. It's a report we're going to do at the end of every month, okay? And what we're going to do is we're going to look at the bank statement and we're going to compare it to our general ledger, and we are going to enumerate and possibly record differences between what the bank says we have in cash and what we say we have. Bank reconciliation. We should all be doing it with our own checking accounts, and most people don't. I don't do it, and I should. I know I should, but I don't. I'm silly. The bank reconciliation explains the difference between the cash on the general ledger and the bank statement and provides information for journal entries. If at the end of the month, my general ledger says I have $1 million, That's how much money we had in our checking account at the end of the month. Then we got the bank statement later, and the bank statement says we only have 400,000. Is that a problem? Is there something wrong? No, probably not. Probably not. The difference is in timing. Timing. This here, this screen here, you should have this in front of you when you're doing your bank reconciliations.
Biting?
This is the template.
Okay.
Uh-oh, somebody's on the phone
Okay,
here.
I'll watch her. Her peak pressures aren't too high.
This is your template. Let's start on the bank side.
You got what?
Well, somebody's talking on the phone. Could you mute that, please? Here's your bank balance. You get that from the bank statement. And then you're going to add what are called deposits in transit, which we will explain. And you're going to subtract outstanding checks and any bank errors. I don't think on your test you're going to get bank errors. I don't teach worrying about bank errors. It just muddies the water. Balance per the bank statement plus deposits in transit minus outstanding checks, you're done. On our side, we're going to look at what's in the general ledger, and we're going to see how much of these deposits have actually gotten to the bank and how much of these checks. Book errors. Now, there we do have errors because we're not as smart as the bank. Any reconciling item under the book, meaning the general ledger, requires a journal entry. And we're going to see that. So let's do our first bank reconciliation together. We're doing it for the end of July for the Simmons Company, huh? I guess that's the mattress company, whatever. So our bank statement came in the mail, and the bank says you've got $9,610. We're saying to ourselves, we don't have that. We only have $7,430. It does not mean anything is wrong as long as we can reconcile. So let's see what we're going to do here. Let's talk a bit about the terms. Outstanding checks. Outstanding checks. That is a check that we wrote that the bank has not received yet. It hasn't cleared the bank. Outstanding checks. I got a refund check about 2 weeks ago from my auto insurance company, $21. So I put that $21 in my wallet here, and I keep forgetting to take it to the bank. Until I take it to the bank, it's outstanding. Outstanding checks are those that we wrote that have not gone to the bank yet. Outstanding checks. The second item here, a $500 check mailed to the bank for deposit had not reached the bank at statement date. This is a direct deposit, okay? Direct deposit. This is a check written by a customer of ours. A customer of ours paid us $500. We got the money on July 31st, and we entered it into our cash. We increased our cash. But then we didn't mail it to the bank until the following Monday, which might have been April 3rd. So it's not on the bank statement. It's a reconciling item. Let's look at the third one. The bank returned a customer's NSF check for $225. A customer paid us, and we put the money in the bank, and we increased our general ledger by $225, right? But the check was NSF, non-sufficient funds. It was a bad check. The check bounced. Boom, 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 boom. We all know what a bounce check is. I've had the misfortune of accidentally bouncing a check, and it's very embarrassing. It's also very illegal. You know, you get in big trouble. So this customer paid us $225, and the bank statement reflects that the bank said, you don't have $225 anymore. We didn't know that till we got the bank statement. And the bank statement is also saying you earned $30 interest. $30 interest. And then they're giving us 2 errors. We made a mistake here. We recorded a check for $240. I don't know how you can make the mistake, but it can happen, right? We recorded a check on our books for $240, and then when we wrote it out in ink, we wrote $268 for God knows what reason. That's a reconciling item, our mistake. And then they're saying that this balance here, this $480 check was erroneously given to us by mistake. It belongs to another company. It's not ours. Here is your template that I was just talking about. Look at your template. Bank balance plus deposits in transit minus outstanding checks equal the correct cash balance. Deposits in transit. Here, the bank has a balance up here. I guess it was 9617. That's the bank balance. But we have to tell the bank things the bank doesn't know. We're telling the bank, well, we had that $500 check that you don't know about yet, so we're putting that there. And we had that outstanding check, and we had a bank error. So let's see what we have here. We start by putting the balances in. So let's take a look. We had a beginning bank balance. The bank balance was 9610. We had that one deposit that we didn't bring to the bank until the beginning of August. The bank made an error. They gave us too much money, and the bank is now going to have to take it back, or we have to be honest enough to give it back. And we had various outstanding checks. So our corrected cash balance is $7,207. If the bank knew all about this, this is where we would be, $7,207. Now we had $7,430, but the bank is telling us things we don't know. So let's see what we have here. And I just need to do something here real quick. Come on, move. Just want to get this thing out of my way here. Give me 1 second. Okay, no good. Our ending book balance was $74.30. We earned interest. We had a recording error and something else. So our adjusting balance is $74.30. Balance for the general ledger was $74.30. We earned some interest, so that's an increase. We had that error, and we had the bounce check. As long as these two numbers agree, we are reconciled. We are reconciled. If there's a difference between these two numbers, and we've done everything we know to balance this report, and we know we did everything right. We know we recorded everything that was on our ledger, and we know we picked up everything from the bank statement. You've got a real problem if these numbers don't match exactly. 7207, 7207. What would happen if we did this report and we ended up with a bank balance of like $100? That would mean likely that somebody stole money. Something's terribly, terribly wrong. The bank reconciliation gives you the confidence that your cash is under control. Now let's look at some journal entries. Any reconciling under the bank does not require a journal entry because anything we're putting under the bank is stuff we already know. This is what we're telling the bank. Here, the bank is telling us. So we have to record this interest income. We have to put this $28 back up or take it out of accounts payable, accounts receivable, whatever. And we have the bounce check. So let's see what they did here. There's our $30. The bank said, you've got cash of 30. Well, that was great. We found that out and we made the journal entry. Debited cash, credit interest revenue. We had that bounce check for $225. When we got that money in the first place, we debited cash and we credited accounts receivable. So that one line journal entry would have been a debit to accounts receivable, a credit to 225. We're just putting it up. And then we had another check where we wrote it in an amount that was too low. And when we wrote the check, we had debited inventory. That's all they're telling you.
Can I ask a quick question?
Katie.
Go back to, yeah.
Katie.
Why do you credit interest revenue? Can you explain that?
Because when we looked at the bank statement, we found out, we looked at the bank statement, we saw $30 in interest.
Oh, I see.
That's all. It's an interest-bearing account. That's all. And you're also going to see interest expense, which would be a reduction. So these are the journal entries on this particular bank rec. Let's go into this briefly. Your FSAs are due, I guess, in about 10 days. Have you gotten your FSAs handed out to you yet? You haven't been contacted yet? Doesn't sound like it. Receivables turnover, very important number. Very important number. This is part of your FSA. You're looking at part of your FSA right here. You are going to come up with what's called the turnover of receivables, which is calculated by taking your net sales, your net credit sales divided by the average receivables, huh? Okay, well, that's easy to understand. What does this tell us? It measures how many times you collect the average receivables during the year. Okay, well, that's understandable, but it's kind of vague and not very meaningful, I don't think. Certain businesses, they might only turn over their inventory once a year. Big ticket item. Boeing, it might take them Boeing a year to make one jet, and then they sell it. So their turnover is just one. They've only sold that one jet one time. You go to Albertsons supermarket and you buy bread, they sell bread like crazy every day. So they're turning the bread over every day. Calculation. Deckers had net credit sales of this amount, and their receivables at the beginning and the end were this amount. We divide that out and we get what we're going to call the turnover, huh? The turnover. And when it comes to the turnover, the higher the better, huh? The higher the better. We want to be selling bread every minute. Every minute we're selling bread. Boeing can't make a jet that quickly. Their inventory, their receivables turns over just once a year. They're both making money. Boeing is making a lot of money because they're charging millions of dollars for the jet. And Albertsons is making money because even though they're only earning a dime every time they sell a loaf of bread, they sell a lot of bread, believe me. So let's talk about something much more meaningful. The turnover is just that. It's just a statistic. How many times you turned your receivables over. A person who works in the credit department of a company would be very familiar with that number. A marketing person, an entrepreneur would be real interested in that number. But maybe the CFO of a company, not the CFO, forgive me, the CEO, the president of a company, the chief executive officer, well, his or her background might be in engineering or advertising or something other than this. And you say, hey, boss, our receivables turnover this year was so far is 7.6. If he's like bosses I've had, he would look at you with a blank stare. He said, yeah, what does that mean? And instead of saying to him, well, it means we turned over the average inventory, you turn it into something anybody understands, days. Days. How many days in a year? 365 divided by 7.6 gives you 48 days. Does anybody want to tell me what that 48 days represents? The average time it takes a customer to pay its accounts. This company collects its money in 48 days on average. You send a bill out on July 1st, and you're going to get paid on August 17th. Okay? End of chapter. End of chapter. That was quite a biteful today, wouldn't you say, everybody? We covered a lot of information here. And that's how this class gets. It gets a little more, what's the word I want? I'm going to say more interesting. I'm not going to say more time consuming. I don't think you're going to be doing any more homework than you've been doing because you've been doing a lot already. But this is all going to tie together now. We're going to start with this chapter, and we're starting with the balance sheet. We're going over sales and cash and receivables. And then the next chapter is all about inventory. Next chapter, you're going to take, instead of doing the receivables turnover, you're going to change cost of goods sold to purchases, and you're going to come up with the cost of goods sold. Questions, anybody? Are you all stunned right now? Want me to go over all the PowerPoints again, one by one? Probably not. Who wants to say something? Anybody? Nobody wants to talk. Is everybody muted? This is unusual.
I'm muted because there's a lot of sounds around me.
Okay, I hear you, George. Can you hear me, Callie?
Yes.
Okay. All right. Nobody wants to say anything. Okay. Any questions? Anything else I can do for you? Anything you want to talk about on the test? We're here. Are you good, Bill?
How did I do on the test?
Bill
Got a 0, huh?
Bill always brags that he got like 107%. He got nothing but A pluses. But no offense, Bill, you spent what, 8 hours a day in the tutoring room with us, right?
Yeah, I did pick your brain a little.
And can I tell them about your refusal to respect the handicap parking spots?
Absolutely.
Would that be appropriate? This is a Bill approved joke. Bill lost his leg in an accident a number of years ago. So he comes around on the one leg. And whenever a new student walks in, when we are sitting together, I say, "This is Bill, and he's the guy who keeps using those handicapped parking spots." Got to stop doing that. Politically incorrect, I suppose.
I haven't used them at all this semester.
No, nobody's used any spots this semester. Huh? Okay. All right. Well, I guess that's it, huh? You give me the friendly raccoon wave, and we'll see you Thursday. Please contact me, text, email. If you want to Zoom one-on-one later, just let me know. Okay, guys? We'll talk to you later. Bye-bye. Got to get out of this. How do I get out of this? Come on. Is it just me and you, Bill?
Yes, I hope so. You never can tell.
Boy, that class got out of there pretty fast, huh?
Well, they had a lot of material.
Yeah, that chapter is really heavy, isn't it?
Yeah, I was hoping that I could bring up a couple of questions that I had on the exams that would help them, like you never did a sales,
Yeah.
Because I remember in 110, the teacher did some tricky stuff, and she had 3 or 4 answers where she debited sales a couple times. And
Yep.
It looked like the correct answer, but
Easy
I
mistake. Yeah.
remember your song.
Yeah, maybe going forward, Bill, I might ask you to join us briefly. You don't have to sit here for the whole thing, and maybe give a few insights on what type of questions to look for,
Yeah, it would be good to know what you were going to cover. Then I could pop some.
Yeah. This seems to be a pretty good group here. So I think they'll do okay. All right. Well, we'll hook up a little bit later, okay?
No worries.
We're gonna have to.
Mika a little bit last night. She's really busy, huh?
Mika, yeah, she's a funny duck. But yeah, we'll have to hook up with Mika on the Zooming. All
Yeah.
right, I got to get this over to my class. Bill, we'll talk to you later, okay?
Later, alligator.
Hey, say hi to Connie.
I will.
Bye-bye.